Good afternoon, everyone, and welcome to BFM's Ringgit and Cents webinar, Stocks, Funds, and ETFs, What's Right for Me? My name is Boon, and as the title of the webinar suggests, today's conversation is going to be all about investing. We'll be focusing on some of the basic knowledge you need to have before starting this exciting adventure, and we'll also try to break down some of the key asset classes that you might want to consider. And helping me with this conversation are my guests, Danny Wong, CEO of Areca Capital, a licensed fund management company, and Stephen Yong, founder of mypf.my, and a licensed financial planner with Wealth Vantage Advisory. Welcome, guys.
Thanks, Sim. Thanks for having us here.
Okay, so
Hi,
just
Sim.
before...
Hi, Danny. Great to be
Hi.
here, and I'm just so excited. Let's have fun on funds, really, this afternoon itself.
Yes, funds on funds. Okay, so just a message to all the people that have tuned in. If you have any questions, do put them in the comments section. We'll try our best to get to them. We may not get to all, but we'll try our best. Okay, so let's kick off with my first question. Why is investing important? Stephen, you're the financial planner here, so why don't you start?
Sure, Sim. So the thing is, as we actually look at our life, all of us, we have our own goals, isn't it? Our own dreams, what we want to achieve, the things we have set out to do, and the things we want to do for ourselves and our loved ones. But the thing is that there's so many priorities, so many goals, but all of us have to recognize that we have limited resources in itself. So it's really about how do you use the resources that we have. That means the income that we get, all this income, cash flow, active income that you get from your work. How does that all translate into building up to make yourself financially independent, to have yourself achieve all the goals that you desire? So it's actually a matter of taking that time to really plan out your journey of how you reach financial independence, where you can ideally just from your investments alone cover all your living expenses and more than that. Well, basically you can choose to fire your boss if you want to, or pursue a career where financial remuneration isn't the key thing, and investments is really that key to help you unlock just all that.
Yeah, I think firing your boss is a fantasy that many people might have. Danny, what about you? Why is investing important to you?
I totally agree with what Stephen has said. But on top of that, I think we have to be mindful about inflation. Putting your money under the pillow, it doesn't help. Not only that, your money it will strain over time. So putting all the money into your low savings account also a risk to you, right? On top of that, I think I totally agree that life is about happiness. Don't try to do everything for you on your own. Sometimes you have to really look for professional to help you on this path, which is less emotion and will be more time and productive by engaging them. I think the other point, I totally quite agree as well. Investment nowadays, it got to be very important to you as a second income stream. Nowadays we have gone through about 2 years of lockdown. Sometimes we may be affected, our income, our primary income may be distorted, but at least you have the investment income to help you out and to hedge your cash flow at times.
Yes, that's very true. So, but Stephen, as a financial planner, most of us, when we kind of like get into the working life and everything, we might have a financial plan. How do you talk to the people that you advise, about investments? How do investments fit into the conversation of a financial plan?
Sure. It always starts with having the end in mind, where you want to be there. And what Danny says is true. Just to segue a little bit, I still remember my life plan when I started out was just to be a takong chai, to work for someone, invest on my own. And back then, when I was really young, wow, you just put your money in the bank and you could get like what 6-8%. And I calculated, oh, I just need to put X amount aside, and I'll be financially independent, financially free. But that just isn't true, just to do how inflation and how rates have gone. So we really need to look at it holistically. So it's like a playing field. Let's say you're playing as a sports game. Yeah. So you need to have both the defense, you need to have the offense, and it all needs to be balanced. So on the defensive side, I won't go into detail, but the basics. You need to do things like your emergency savings, your risk management, your insurance. So nothing unexpected totally derails off your entire lifespan. And then when you have that set up, then you can go full force on the offensive. So that's when you actually look at your investments. And with that, it's really having that, what is your personalized investment plan? So a lot of times when we do investments, for a lot of us, it's we read something online, or we hear something, or friend, family member, relative approaches us, and we have these little bits of investment everywhere. But ideally though, I proved it to you that you should have your perfect investment plan. It's like a jigsaw puzzle. You have that perfect picture how your entire investment portfolio should look like. Then only you look for all the right pieces that actually make up your personalized investment plan.
That's really good. Okay, so now let's anchor this conversation on these two key pillars, active and passive investing. Danny, why don't you start? You talk to us about the difference between active and passive investing.
Yeah, passive investments are investments that actually one hold it without intention to do more frequent trading or buying or selling. So one of the examples is actually investing in ETFs that track certain a common benchmark or index, where you just write on it. For example, you want to buy ETFs on S&P 500 index, which is in US, then you track on it and for long term. The opposite of it is actually an active investment. Active investment are investment that takes a hands-on approach, where it requires someone to act, to make active research, for example, asset allocation and security selection along the development of market condition. You have to be very aware of the market dynamic. For example, company announce results, whether certain government policies, for example, inflation rate and whatnot. So you have to take into consideration all this. Active investment require a lot of resources. So the goal of active investment is just to beat the market average rather than tracking the index. So usually we look for delivery of alpha, or we call it excess return, over a passive investment. So you need a very deep analysis and expertise to know when to pivot into a particular stock or bonds or any other asset class.
And we'll get into that a bit, but Stephen, I want to ask you now, how do I determine what's right for me, active or passive? Must you even choose between the two?
That's a very good question there, Sim. So the truth is that all of us have choice, and all of us, we are all uniquely, individually created. So with that, it's really recognizing that what are your interests, what are your strengths. Hey, if you're someone who hates looking at numbers, even logging in to look how your investments are doing, and that to you is the worst thing that you could possibly spend your time, that's probably a sign that active investing isn't probably the right fit for you. But if it was something that, hey, you love looking at companies, you wish that, I've seen this company, I won't name names, but you're excited about this company, maybe renewable energy or disruptive technology, or in various other areas, and you're just excited. You want to be an owner, you want to be part of it, or you want to be, even semi-passive investments like property, for example. You want to be a property owner, property landlord. So it's really a mix. So there's really no one size fits all. It's really recognizing what your key areas are. And the thing is, again, we started off talking about limited resources, and time itself is a limited resource as well. There's no way as an individual investor say that you can do research for 50 plus individual securities or stocks and try to just keep track of everything, unless that's your full-time job. It's just not gonna happen. So for most people, it's really picking up battles, knowing, okay, which are the active investments, if any, that you want to focus on, and which ones you can actually focus, letting be more passive, letting professionals actually work on your behalf to actually gain you that alpha and that returns that Danny talked about.
Okay, but Stephen, I'm also curious, does personality come into play when deciding what's right for you? Or are there like other considerations, like maybe your risk appetite, or I think a factor that many people consider is age as well.
Sure. So there's a mix of both personality as well as knowledge. So for a lot of people, especially Malaysians that we're talking about, a lot of times Malaysians are afraid to invest when they don't actually know, they don't have that confidence, don't have the insight. So the key really is to actually unlock that knowledge, that insight. Once you actually get that confidence, then okay, you can get your toes wet, get your feet wet, and then just build up from there. So another thing that you brought up, Sim, and it's a really good one, talking about age as well. So it's really recognizing that the time horizon between where you are today, say you're in your 20s or in your 30s, and the timeline for your goal, say if it's for your retirement, maybe in your 50s, or you're planning for your children's education at the time when your child turns 18 and you want to send him or her, your little prince or princess, for tertiary education. So it's really recognizing that time horizon and how long that you have. Then it goes into then what sort of asset allocation, what sort of investment should go into that, and then what's the best way for you to fit into that sort of asset allocation. We are recognizing that as you get older and your timeline gets shorter, you need to be more liquid, you need to probably take on a little bit less risk.
Okay, so now let's move a bit on this asset allocation conversation, and focus on passive investing. Let's start with funds. Danny, how does one go about picking the right fund for them?
There are many types of funds available here, and beyond Malaysia also there are others, right? But just very commonly available in the market is actually the equity funds that invest in equities. But within the equity fund itself, there are many types. For example, growth fund, which is talking about slightly longer term to garner something beyond the ordinary returns, right? But you have to accept the risk, high return. There are also dividend funds, for example, which is income, derived from the buying into the dividend stocks. You have also equity that tracking the index, which is, for example, Bursa Malaysia. You just buy on the key stocks. There are also other equities fund, which is like small caps, big caps, whatnot. You have others. Now, beside the equity funds, you have bond funds, for example. Now, bond funds, unlike equity funds, which is looking for capital appreciation or some kind of regular returns from dividends. Bond fund is more like you're buying something that steady AD, right? Not fluctuation, not that much, right? And that capital preservation is actually more important than the equity funds, right? And on top of that, you want to look at long-term bond fund or short-term bond fund, or you may have even junk bond fund, right? So look at high yield, and you can also look at lower volatility fund like cash fund, money market fund, and on top of that, you can buy any other like structured funds as well, So you can have those things. There are many types of funds in Malaysia, including ETF fund, including Robo Advisory fund, including all kinds of funds. They're now coming up with a lot of the different categories of fund.
Yeah, okay. So, there is so many funds out there, but Stephen, investing in funds, it's not that easy. There are some things that you need to be aware of, like fees, front-end load, management fee. I mean, can you talk to us a bit about the considerations that you should make? What should you be aware of when you want to invest in these many, many type of funds?
Sure. Fees, as you mentioned, is one of the things to look at, but not the only thing, of course. So the realization that fees does eat into your returns, and even if a difference of let's say 1, 2, 3% in fees, although may seem small, but if over a long period of time, it can make a significant difference as well. So ideally, of course, in a perfect world, if everything else was equal, you would want to look at basically what would be the lowest fee option available. But with that, you need to recognize as well that not all funds are created equal. Different funds will have different structures, and you mentioned as well front-end load. Whether you have to pay sales charges when you enter, is there an exit fee when you exit as well? What about management fees? So all that does add up. But it's really recognizing really of matching your goals and how your ideal asset allocation should be. So Danny earlier talked about whole long list of funds. Even for myself, if you ask me to recall what Danny just mentioned, there's a whole long list, it slips my mind as well. But basically, it's just knowing that there are actually 5 major asset classes. The first would be cash equivalents. This includes things like the money market funds that Danny talked about, includes more traditional things like, fixed deposits and so forth. There will also be then bonds, whether you do bond funds, whether you buy direct bonds or fixed price funds. Third would be equities, and again, there's various ways, whether you stock pick, whether you invest locally, overseas, whether you do ETFs, whether directly use discretionary portfolios, use Robo Advisories to get ETFs and unit trust exposure. There's again so many options. Fourth would be properties, whether you do REITs, whether you buy physical property, commercial property, land, etc. Fifth will be alternative investments, and that's your gold, your crypto, peer-to-peer financing, equity crowdfunding, private equity, and so on and so forth. So it's really recognizing that you need all 5 of these major asset classes, and how do you actually put it together, and what would be then the best way for you to actually structure that in terms of both returns, performance, and how I think increasingly as well, just this really important point is how well managed these investments are. So gone are the days where you just buy a fund, just because it's past 5-10 years historical performance was really good and expect it to do well into the future. That just doesn't work anymore in today's dynamic world that we're in. So you need portfolios that are smart. That means either the portfolio itself, or you have an advisor, someone who's actually managing your portfolios for you and making those strategic changes over time. So as an example, REITs or equities, 1 year it can be the best performing, the next year it can be the worst performing. And if you're not ready for it, you might get a heart attack. And we hear stories as well. People just get so afraid, they buy in at a high, and then it drops, and then they just panic and so you definitely want to avoid that kind of scenario.
Yeah, I think sometimes it's
totally
important.
agree.
Yeah, Danny,
Yeah,
yes?
same. I think totally agree with Stephen. I think one of the key things is actually performance, but not just performance. It's actually after you consider the risk reward is more important than just the returns alone. Of course, performance defines a fund manager, and not just looking at 1 year or 3 months. Buying, especially you have a long-term goals, you shouldn't match your short-term volatility to a long-term objective. That's actually a mismatch of your risk profile. You should look beyond 1 year. Actually, 3 years and 5 years time horizon to review a performance of a fund manager is actually sufficient. And more importantly, to make sure that the fund manager doesn't change. So you don't buy a fund that every year keep on changing fund manager, and then every year they have to review the style and portfolio, and that doesn't work. So beware when you choose funds, and beware when you deploy your assets according to, or your money according to what you like and according to your risk profile. Buying a fund, you should look beyond 3 years, right? If you are not prepared to look at the fund for 3-5 years, I think then you better put the money in the banks already, because you cannot take that kind of volatility. So again, what Steven says is correct. Appoint an advisor, because that will take away your personal emotion away, and the professional will advise you what to do according to what your needs and your objective and your risk profile.
Okay, but what are the benefits and drawbacks? I mean, we talked about some of the benefits and the how to look at the performance, but what are the more like obvious benefits and drawbacks when you talk about investing in funds? Maybe Stephen, you can give some insight on that.
Sure. So as we look at funds, what you're actually giving up, of course, is the individual control. That's one thing. That means you don't have that choice, because you have actually delegated that choice to a professional, whether it's a robo advisory kind of style, or it's a team of people, or hybrid of both, to actually make that investment decision or investment calls into what exactly is invested to. So you do get access to a mandate. Usually you might have options where, if let's say it's a robo advisory, there will be different risk profiles that you can select. Or if you look at a fund, you look at its prospectus or its fund fact sheet, you would know, okay, what is the composition, how many percentage, what are the ranges into equities, bonds, or into other areas. But you are recognizing that you are letting go of that control, which you may or may not want to do, depending on your expertise, depending on how much time you have. So really it depends on the individual. And the other one, as Sim, they pointed out, the drawback would be the fees as well. So DIY is generally the cheapest way, because you are basically trading your time actually to do that research and that analysis. So the question is, if the amount that you're investing, is it worth your time and effort? Do you have that knowledge to actually make that investment, or would it make sense for you to use a fund?
Yeah, I think a key point when it comes to fees also people have to realize is the fees you pay is still going to be that set rate despite whether the fund loses money that year or not. So you have to realize that. But okay, Danny, you did bring up bonds earlier, and there's an assumption that the bond market is somewhat easily accessible as equities, but in Malaysia that's not so though. Maybe you can expand a bit on that.
I presume you're referring to direct investment in bond
Yes.
itself. Yeah, the trade lots of bonds is huge in Malaysia. Used to be 5 million a lot, but now they actually come down to even 1 million a lot. Yeah, it's not easily available. Usually, it's actually at the primary market when the issuer issuer issue the bond to most of the institutions, and it's not make available to individuals. Of course, there's one or two small issue that can make available into, let's say, mini bond and which is listed in Bursa, right? But very rare on that part. So because of the size that they come out, so very hard for individual going to buy bond. Even you can afford, you have 5 million or 10 million, you wouldn't hold the whole 5 million into one bond because there's concentration risk, right? So usually split. So one of the better ways is actually going to the bond funds, where the bond funds have the size big enough and achieve economy of scale, and then diversify into multiple bonds. Each of bond will be a fraction of the funds. And when you buy into the bond fund, you are buying the units of the bond fund, which is already diversified. So you can even buy as small as 1,000 ringgit or 10,000 ringgit to enjoy the bond returns. Of course, you have to understand how the bond fund works and then what type of bond fund that may suit your risk profile.
Okay, so now, I want to move this conversation now to this something that's somewhat new in the world of passive investing, which is, as you've mentioned earlier as well, Robo Advisors. Stephen, let's get your thoughts on Robo Advisors and how they fit into someone's investment plan.
Sure. So Robo Advisors are a tool. It is relatively new. So basically what Robo Advisors do is that they basically help you to manage a portfolio of different funds, typically into exchange traded funds. Some do have some exposure into unit trusts as well. So you're basically selecting based on a risk profile. Some Robo Advisors allow you to go through some questions to help you determine your risk profile. They would have some projections. They make investments easier as well, in the sense that it's more visual because they're very tech focused. The amounts to invest as well start very small as well. So most Robo Advisors in Malaysia start from as low as 100 ringgit. So it's a very easy way for people to start investing. And with that, a single 100 ringgit, you're not just buying one ETF, which is already diversified. You're buying a portfolio of different ETFs. So you're talking about fractional investing into various different ETFs. So it helps to build up a portfolio quickly and easily. The fees as well tend to be a little bit on the lower side because they leverage on technology. Still, with that being said, you need to be looking at robo-advisors. So robo-advisors can fail as well. There was actually with last year, where we saw when the pandemic actually hit, there was actually a robo-advisor with our neighbors down south in Singapore, where a robo-advisor actually closed down as well. So that was actually an effect as well for investors. So it's really recognizing how much is the allocation into a single robo-advisor, and it probably doesn't make sense to put 100% of your investments in the robo-advisor because you're not getting the proper asset allocation. What if your direction is not exactly aligned with the robo-advisor because it's not personalized, it's not customized to you? What we are seeing though, especially overseas in the States, and we believe that this trend will actually come to Malaysia as well, is that robo-advisors are moving away from being just pure robo-advisors, but working together with financial planners. So you have that robo-advisory and you have your financial planner to help you to structure maybe not just one robo-advisory, maybe multiple robo-advisories, multiple portfolios, multiple funds, things that aren't available on robo-advisors as well, putting it all together to make your own personalized investment plan.
Yeah, that's interesting because now I want to move this conversation to Danny, who, you're a fund manager, and this rise of robo-advisors. How do you view this, and how do you, maybe as Stephen has said, approach working in a world where robo-advisors are starting to become a norm?
Yeah, I see the very positive development here. While there are some saying that this is a very disruptive to fund manager with the robo introduced to the world, I totally disagree with this one, because we ourselves at Areca, we actually employ the strategy working along with the robo, because we have only two hands, two eyes, and we have a limited 24 hours, and we cannot keep track of. For example, Bursa have 1,000 listed stocks. In the world, there could be millions of stock. It is impossible for us to hire, a team of army to study all the stock in the world and just to come up with the global funds, for example. No. And what we do is actually, for Areca, we actually employ a top-down approach where we have set the parameter for the funds. For example, in view of current situation, we should be going aggressive. Then we should deploy more cash, like 80% into the work. And then we should also, let's say, pick some good stock because things are still not certain. So, for example, key in the parameter for dividend yield must be 3%, and this company must have a balance sheet, strong balance sheet with cash at least 30%, and carrying cannot more than 1 time, for instance. And from there, we key in all the parameter into the robo, and the robo will generate an particularly now it's actually machine learning robot. So they will generate and then test the idea and run the machine and have memory on this and learn according to the data and project the new things, what will happen to that. By then they will screen out the investment, and these are the investment, is actually a list. And then the fund manager decide, these are the list, shall we do this? If it's agree with that, it depends on the house. If they say, I just need 20 stock, just filter the 20 stock and then press a button, order. So it is our time and effort to screen the stock, but our idea of active management is still there. So it's a good combination of active management with robo there, and then we will change accordingly. So it works very well, and it will. That's why now the performance is getting better and better with the robo advice. However, the disclaimer is that the type of robo you must know how do they work and how do they learn the machine, and not just pure buy and hold. And the other one is actually certain robo, they are workable in certain market. For instance, the robo in emerging market, right, may not work as well in developed market, because developed market the information flow are more or less there, whereas in the emerging market there are some mismatch of pricing, there's some information partially available which robo may not know. Then from there the fund manager input is very important. So more like Malaysia, as a fund manager, I think the robo advice, the robo picking stock skill is more applicable to the developed economy. And Malaysia, I think we still have that a little bit of room for us to develop alpha from the investment, means outperformance from the stocks where generally machine will not know about that. So you have to know this combination. But to me, it's not disruptive. To me, it's embracing this technology and robo algorithm into our work and make our job more efficient.
Okay, so we have a question here from Malik, and this is the question he's asking basically: is it fair to say that emerging markets, it's best to choose from active fund managers who know the local market, which is something of what you said, Danny, but for established markets to just buy passive ETF fund? I think he's citing Tong's Malaysian portfolio on the edge, which performed brilliantly against Bursa, but marginally better against the MSCI World Index. I mean, they themselves have admitted that for most investors, a passive global portfolio makes money sense. Danny, this question, I think you can take it on.
Yeah, I totally agree with this. I think it is easier to use a robo in the very complex and very developed market. From there, you have a handful, but just be careful when you use a robo. You shouldn't use a robo to chase certain big caps name, for example, because there's actually a self-fulfillment of a performance. Just imagine that you use a robo to replicate or other the performance of index, but the index is driven by a few key stocks, and these few key stocks that keep on performing, their weightage on the index becoming larger and larger. The top three funds, the top three stocks could have been, influence the index movement. Then end up the robo have to keep on putting the money into this stock and making this stock even bigger and even performing. But what if one day this something, a black swan event that triggered the reverse? Again, the robo have to sell, and because of this big position in the index. So you have to be careful on that. But in the developed market, active fund management skill can perform well above. I think like what everybody knows, that you read the age, and Tong's portfolio is actually can outperform certain things. Similarly to our house, for the past 14 years and 14.5 years, we deliver 500% over 14 years. So every year we can produce like 17% on average, 14 to 17% on average, that outperform the index just merely 2-3% over the past 14 years. So that actually proven that Malaysia, even people say that Malaysia cannot make money. Wrong. Malaysia can make a lot of money. If you know
everywhere
how to
can make
do it.
money.
Yes, correct.
Okay, so now's my cue. I guess we are moving our conversation now to active investing, which is like you said, stocks and equities. This is where they come into play. Danny, if I do decide to look into stocks, decide to stock pick, what should be my guiding principle?
All right. I think not everybody actually has this skill or thing like that. But what you need to do, first thing, you have to understand yourself first. It's just like know myself, my risk profile, my style, right? Second thing, you have to know the market, of course, overall. and then you have to spend time to really to do it. So when you pick stocks, you must really know what you want, which stock actually suit your needs, and you don't need to know the 1,000 stock in hand. No, impossible. What you need to do is just study maybe 20 stock, and of which then you can pick a few that suits your needs and your style. For example, you are the person that your character, your personality cannot take, sudden drop of 20%, then you should avoid those high risk stock or growth stock, for example. Then you look for dividend stock, which can give you 7% per annum on dividends or yield, like REITs, and then at the same time, over a long time, it can produce you some kind of capital appreciation, but steady AD. So that kind of thing, you have to be really watchful of your own thing. But of course, you can make use of certain information in the, available in the website even, or you can Google it. In fact, things like you can use metrics, you can use formula to track, certain comparison, whether the stock is overvalued or undervalued. But one key thing is actually, even though you know this metric, it may not guarantee you will make money. You have to really have the holding power just in case systemic risk happen. It's just like COVID-19 is a systemic risk. That you diversify, it doesn't help you, because even you hold 1,000 stock, diversified very well, but when the pandemic comes, everything come down. So you must diversify into different asset class while you can pick the stocks. So you must know that. But among the stock, you hold 1,000 stock doesn't mean you are diversified. No, diversification in this case, diversify your risk away. So you must pick maybe 5 stock, but this 5 stock may have rather very distinct features of risk that one down, the other way hopefully will even out your downside and go up. So you must really to have that study. So by virtue of applying just, for example, a PE model doesn't work sometimes. You have to look at the overall picture before you look at individual stock. But the Malaysian usually are just ignore those things and go straight to quick stock that they like and hearsay and straight away buy and hope that tomorrow can be very rich. That's the wrong way to do things.
Yeah, which is what I want to ask Stephen. I mean, the people you talk to in your role as a financial planner, what are the common mistakes, the common kind of things that make you go shake your head when you talk to them about stocks, when they come to you and say, like, I want to try investing in stocks? I mean, how do you warn them? How do you prepare them for this?
Sure. So it's really looking at that individual's background, which Danny has alluded to as well. How do they actually measure the stocks? And also, I think the first key question really is that what's your time frame for investing in stocks? Are you a long-term investor where you're investing for the long term? And when we say long term, you're talking about 5 years, or longer. At the very least, you're 3 years plus. Or are you an active trader? Are you trying to trade, day trade, swing trade? Or worst case scenario where someone says that, okay, I am actually going to be a trader, and then when they trade, and then suddenly the trade goes wrong, and then they suddenly say, okay, now I'm an investor and I'm going to hold this stock, very long into the future because it has gone down so much. So it's really recognizing that there's a different game, whether and it also involves as well where, for example, if you're doing more short-term trading, you don't really care about fundamentals, where you're just focused more on the technical analysis, the TA side. Or on the long term, you're looking more at fundamentals, and again, there's various breakdowns as well. Are you looking at value plays? Are you looking at growth, investing into stocks itself? Are you looking at dividend plays? So it's really about how do you actually build up that portfolio, and that allocation, that diversification, which Danny mentioned, that's so important as well. So one of the forms of diversification is across different sectors as well. With that being said, there is something about being overly diversified as well. Or when you hold 50 stocks, it just doesn't make sense because you can't monitor them all. Or you say you're diversified, but you're buying everything is in the technology sector, for example. Again, that doesn't make sense because you're actually not being diversified as well. So it's really finding that balance, recognizing what your knowledge is. And one key challenge is when people get a bit of knowledge and then they think, wow, I'm now an expert and I know everything. It's recognizing that we need to be humble, that there's actually a lot more for us to learn and to grow from as well. I've been investing in stocks directly as well, for more than a decade plus. And, I by no means would consider myself an expert in any way as well. So it's really recognizing and be humble as you proceed with that.
Right.
Same to fund managers. Fund managers doesn't mean that they are really expert. They could be spending more time and experience in certain field, but they are not experts.
Yeah, I think every day you learn something new. But okay, all this conversation we're talking about when it comes to going to stock trading is all about making money. You want to make your money, you want to see your returns. which might not be the case all the time. So Danny, when it comes to stock picking, when it comes to investing in stocks, if it doesn't make money and it's losing money, at what point when should I cut my losses? How do I decide this is too much, I need to let go?
Assuming you already done your study, you have your standby cash flow, emergency cash flow. This is only for your investment purpose. Right? You know yourself whether you want to have a cut loss situation or you are not. But sometimes certain stocks, they are fundamentally good, but they're affected by the short-term sentiment. To me, there are actually three factors when investing in equities market. You must understand the interplay of these factors. One of these is the sentiment of the market. You may be positive on this stock, but the whole market is bearish about the whole market. Your stock will also affected by this sentiment. Second thing is liquidity in the market. Right? This factor is also important. Whereas the whole market, for example, full of cash, even the lousy stock will go up. That's explain the bull market that auntie uncle can still go buy stock and become expert at buy somebody to buy it. That's because the sentiment and also liquidity play. But the flip side will happen when the liquidity dry up, for example, and they increase interest rate and whatnot, some of the money will leave the equity and go back to bond or go back to the deposits. Then the liquidity string. Then by then, some of the stock, even the good stock, it may come down. So the key thing is, these are the two factors that affecting the short-term movement of certain stocks direction. But the interplay of this you must understand short-term, but over the longer term, the intrinsic value, which is the third factor, shall prevail on these two. So no matter how the stock up and down, you still have the fundamental. At the end of the day, one point you will settle at the intrinsic value or the real value of the stock. So by then, you will know whether it's actually you are buying for, let's say, you target a price of, you think that this stock going for a PE and the earnings per share, you will hit, let's say, 250, today is 140, then you hold on it should be okay. So buying stock sometimes for long term, you got to be patient. You cannot have a baby within 1 month and getting 9 pregnant lady to produce that baby. Cannot. You must really be patient enough to wait 9 months to have the baby. So that is actually investment philosophy of it. So be careful when you pick stocks, and it's not that simple, but you have to be patient. Once the condition is there for the stock to perform, and you think that this fundamental is right, ignore short-term volatility. These are the noises will affect your decision and emotion. Right? So sometimes it's a good stock, you could read, but you must have a clear. You are right. You must have a clear cut loss policy.
Yeah, and then.
Yeah. The fundamentals.
I was going to remark. Yeah.
Cut, you have to really, even lose money, you cut, then you look for another stock that can give you the potential. No point you're holding something that is actually not going to produce something, but the other hand, actually you forgo the opportunity. Sometimes you have to switch. Painfully cut, you just cut and then go other. Some of them because of the psychology and because of the emotion. I love this stock so much, I have been making money so much, but now it's a falling knife and still holding it. That's explain why people have a deep loss.
Opportunity cost. Stephen, you wanted to add something?
Oh, I just wanted to share a few quotes, as Danny was sharing, and this quotes came to mind really. So one is, never fall in love with your investments. That addresses what Danny was just saying over there. And to Danny's second point, it is so true that a rising tide actually raises all boats. But when the tide goes out, then who's actually swimming naked really.
Yeah, I think that's very important, because I think one of the lessons we've learned in the past year is that, when something gets really positive news, everyone wants to jump in on it. Everyone suddenly becomes an expert. Everyone starts, trying to prop it up. And when it falls, and that's not that great. But and this relates to this new kind of phenomenon, I guess, or rise, which is meme stocks, that we're seeing overseas, GameStop being the biggest name you can hear. Stephen, I want to get your thoughts on this, rise of meme stocks. I mean, how do we, what are your general thoughts on it? And is it a good thing? Is it a bad thing? How would you approach it?
Sure. So it's this, GameStop is a prime example of a meme stock. Palantir was another one. And these were basically made famous through Wall Street Bets, which is a Reddit group that actually is full of punters that are speculating on that. So, as the name of the group itself, Wall Street Bets, it is talking about betting actually. So it is really actually a bet, a gamble, whether something moves in the direction. Because if you look at it fundamentally, GameStop, for example, it just doesn't make sense actually for the stock to have gone the way that it did. So one is if you recognize that yes, you do have that capacity to gamble with that funds, or you're putting in play money that you don't really mind, it doesn't affect your net worth, your entire investment portfolio in any way, even if you lose it all, and then you put a little bit into that, that's fine as well. But it should be a really, really small percentage of your portfolio. And that even more as well, because Wall Street bets, there's more in the States. I think for more Malaysians, they would actually be more speculative into cryptocurrencies actually, where there's actually a lot of shit coins, pardon my language, but basically altcoins which are really have no real value, and they're just punting, hoping that to make multiple gains. So basically, beware. If you're doing it, recognizing that you're doing it just for fun, unless you actually have some real knowledge of what actually is happening. But for most people, and for myself, I would just stay away, look at it, enjoy the show, but I wouldn't have my own skin in the game for that.
Yeah, cryptocurrency is really, really fascinating, and that's talking about it really deeply is a conversation for another day. But really quickly, Danny, I just want to get your thoughts on cryptocurrency. With your experience in this field and everything, this cryptocurrency emergence, how do you view this? How is it a new kind of animal, or is this like a fad, something temporary, or is it going to be here to stay, to change the landscape?
I think there are two types of crypto, but before that, we must understand this crypto is a really new thing to us. It actually started with of course the famous bitcoins, which is started by this Japanese unknown person. So Japanese name by this Satoshi.
Or persons.
All persons. You don't know Satoshi Nakamoto. That he started with this bitcoins concept in the white paper in back to I think 2008. 2008, that they limited to 21 million of bitcoins, and then then now look at recent years, like bitcoins has crazily go to certain price of 46,000 USD or 60,000 USD, kind of things. But reality, I try to spend time to understand this. I understand the blockchain, I understand how this crypto work, but to what extent this crypto can run to 60,000 USD and what is the fundamental underwrite to it, I couldn't understand until today. What I know is actually there are certain people initially get mining of these bitcoins, and then they're still recorded as the very few initial holding majority of this bitcoin, where they are the richest man in the world if they were able to cash out these bitcoins. But the actual point, I don't know really what is the fundamental. If I don't know anything, I cannot assess, and there's no way or methodology to assess the valuation of the Bitcoin, whether it's undervalue, overvalue. As a fund manager, I would not touch those things. But having said that, there's another type of the cryptocurrency where they have the backing of it. That means they have asset backing of it. For example, a government issued cryptocurrency. So when they don't call it cryptocurrency, they call it digital currency, right? Where they can back their own gold reserves or the forex reserve to back to the cryptocurrency, and then there's how they do it. So without the fiat currency, means without the physical note, with the digital pocket or wallet, and with your handphone, you can still utilize this digital asset to buy certain things. And this way is actually a good way to actually there's an advantage to it. For example, you can actually reduce the illegal money floating in the country, right? So those are corruption money. You cannot have physical note. Once you switch to that, the physical note is actually of no use. Then you can actually fill up this patch of the illegal money. The other thing is easy to account for. You can track everything where this is, right? So there are pros and cons, but actually today it will not be the forum for that. If you go into the cryptocurrency, it will be too. We need 1 hour to discuss.
Maybe a webinar for another day. But okay, now I want to take this opportunity to address some of the questions that we've gotten through. I think there's a question that comes from Sueli. Sorry if I got your name wrong. Sueli. So she's asking you, Danny, if my portfolio is 60-40 ratio of my cost of investment, the cost of investment I put in should be the net amount after deducting total personal debts. What are your thoughts on this?
Sorry, I think the 60-40, I'm not sure what does it mean by 60-40. Okay, what I would do is actually you have to look at, assuming this is really, because you cannot net off just the debt. If you're available, they say whatever wealth is available, you cannot just look at the debt itself. You should actually, to me, it's the wallet concept. wallet means the savings accounts, for example. So you have to take care of your day-to-day living, at least. You know, for example, you have to have dinner, you have to have breakfast, whatsoever, day-to-day spending. So you have to take care of second things, emergency, for example, you know, your maintenance of your cars, you know, you sometimes you also fall sick to see doctors, you have to buy some vitamins to maintain your current status, right, to be able to move forward. Thirdly, you must also look at your wallets that you can spend beyond these two necessity. Like for example, you need to travel, you know, once a year you need to see for example, see the world in the northern lights, for example, you want to have a cruise, prepare for that. And then finally, as Eastern people, we try to leave something for our next generation. So these are the few things that you do some charity, for example. So once you settle for that, the remaining, then you can look at it of each of these objectives of this wallet will have this objective. For living, you have to be very very liquid. You can draw anytime, right? Whereas for those retirement, you can live it for long. It could be 20 years. For those who live for the next generation, you can be just not your age. You could be 50 years old, that you think that you have 30 years to go, but in actual fact, your next generation could have another 50 years to go. So your investment object could be 80 years to go, you know. So it's different objective and different time frame. So for that, it's very hard to just one size fits all, and this is a standard formula. With 60-40, you can do this. Is very hard. But once you settle that, whatever amount that you think that you have, let's say minimum 5 years to go, then you can choose something that can beat the inflation, can beat the FD, for example, and grow your wealth according to objective. For example, you need to have 7% per annum or 10% per annum. Then you pick the right asset class that meet your risk return profile, and then you can go on. For example, in longer run, in general, equity tends to outperform some other passive asset classes. Then you may consider something more on the equity, but you don't put all into the equity. It could be maybe 60% or 70% equity, right? So very hard to have a formula that everybody can follow. It does not work that way. It's not the one size fits all kind of formula.
Yeah, right. I think it changes time to time. We have time just for another question. Is coming from Tanusha, and I think Stephen can take this on. The question is asking, many people are waiting to have enough or extra before they can invest, and given the many financial commitments that people have, people may assume that they do not have sufficient capital to invest. Stephen, what are the strategies that you can address it with this mindset?
Sure. So you actually want to start with looking at cash flow. So there was a saying, cash is king, and that's not really true. Cash flow, though, is king. So you really need to look at it from a cash flow perspective. What is your actual income coming in? What are your various expenses? Is there ways to actually optimize that if you've been really, really struggling to find that money to invest? So are there expenses that you don't really need? Maybe a certain subscriptions, things that you don't use, or else it might actually be really looking at income. So a number of clients actually told me as well that, wow, after I realized that the clients I talked to as a licensed financial planner, a lot of them, after talking to me, somehow or other, they ended up changing jobs or getting a promotion at work. So it's really realizing that there was actually a need for them to increase income, whether it's through their work itself, through employment, or whether they're a business owner, or whether it's from various side hustles. So with that, you can generate that additional cash flow to put into investing. With that being said, not any amount is too small. So even if you have 100 ringgit, even if you have 10 ringgit, whatever amount that you can set aside, the thing is to get started first. So it goes with the concept of paying yourself first. So have that picture in mind. And again, this is a rule of thumb. So do talk to a professional, work out the actual details. But a general rule of thumb is that if you are contributing to EPF, besides EPF, you should also be putting aside at least another 20% into investments. So look at your income and what you're setting aside. If you don't have EPF, if you're on your own, you're an entrepreneur, etc., 40% is a really good amount to actually set aside. So set that amount aside first, and then leave off the rest that you have. And once you realize that, hey, actually money is just like water. If you don't put it somewhere, it's just going to flow away, really. So if you actually set it aside first, put it into investments, make your investments automated, and that fits into various other strategies as well, such as doing dollar cost averaging, for example, or putting in those monies on a regular basis into various investments, so you don't have to worry about it. Every month, your income comes in, it goes up into your investments, and hey, you can blow it all, and you're perfectly fine because your investment goals have been met.
Okay, so lastly, we're gonna go towards the end of this webinar. Stephen, what are the key takeaways that you hope our listeners will gain from today's conversation?
Sure. So if there are key takeaways, I would say with this, one is really knowing asset allocation. And rather than even the individual investments that you pick, asset allocation is actually the most important thing because asset allocation actually helps reduce risk or volatility by about 90%, and that's huge. And actually accounts for about 40% of your returns. So know what's your proper asset allocation and make sure that you're diversified. Second, have a plan. You need to have direction. You need to know, are you more active? Are you more passive? What sort of investments should you be looking at? What sort of returns each investment is actually expected, and are you actually generating those returns into the medium and long term, or should you be cutting loss? So have your personalized investment plan. And last but not least, consider working with an independent financial advisor who has your interests and your thoughts at heart.
Okay, and Danny, final words go to you. Since we have a fund manager here with us, what's your market outlook for the rest of the year?
I remain positive and sanguine about the economic recovery, right? So over the next 6 months or so, I'm positive on the recovery. So therefore, for those who want or can take this risk into equity, maybe not just 6 month time frame, but beyond this, I'm still positive about that. So currently, we must actually know what are the culprits that caused the Bursa actually down. There are two main culprits. One is actually the pandemic, which is happened to affect the whole global markets, right? Second thing is actually the unique to Malaysia. The main thing is actually the political uncertainty. But looking at current situation, we have very high rate. Even like some of them say that it's almost like 70% of adult already been double jab and then vaccinated. So that the economy started to, some of the government actually starting to relax on some of the SOPs. From 181 SOP now down to only 10 SOP per se, and then you start to open up the economy. So this thing will come, right? The second thing is actually the politics. So with the lately there's a change of PM and then they work together. I think this risk has somewhat subsided. With these two major culprits already somewhat the risk is reduced. I think the market will look forward to regain what it lost, and perhaps some of the corporate earnings will come back and then make more earnings. So watch out for the next 2 quarters or so, the recovery of this earnings. So we employ a barbell strategy at this moment. On one hand, we look at sectors that actually benefit from reopening or recovering, right? Things like banks, things like proxy to the economy, like consumer stocks, but not everyone. The other one is actually look at growth factor, which is remain the mega trend. For instance, exporters, manufacturing, or the other one is actually the main theme, which is your growth factor on this technology or semiconductor. Because over the next few years, you will hear this mega trend of electrified cars, EVs. You have Internet of Things. You have 5Gs. You have the development of smart things, software and whatnot. This will encourage the technology. Malaysia typically will benefit from this kind of development, and you look for 3-5 years, it could be even beyond that. You will earn that growth. So with this reopening, the value proposition plus this growth factor, you are well hedged. Whichever come, you will also benefit.
All right, and I think we have reached the end of our webinar. Thank you guys very much. I've been talking to Danny Wong, the CEO of Areca Capital, and Stephen Yong, founder of MyPF.my, a licensed financial planner with Wealth Vantage Advisory. Thank you everyone for joining us. We'll be posting a feedback form in the comments section and would love to hear your input. Apologies if we didn't have time to get to all your questions. We'll try our best to get to them after this. I'm Boon, and this has been a BFM Ringgit and Cents webinar. We look forward to the next one. Take care and stay safe, everyone.
Thank you. See you.
Thank you. See you.